the stock market has just pushed into new record territory. At the same time, gold prices have reached levels we've never seen before, and silver has also broken past its previous highs. When you see all three moving like this together, it's not random. It's a signal that something bigger is happening in the financial system. Recently, the U.S. Treasury Secretary appeared on national television and made a statement that caught a lot of attention. He said that while 2025 was a strong year for markets, 2026 is expected to be even bigger. He described 2025 as the setup and 2026 as the real payoff for investors. That tells you exactly what policymakers are hoping to achieve. Despite all the talk about recession risks and job market concerns, investors need to focus on one thing above all else. Money doesn't move based on fear alone. It moves based on policy, liquidity, and incentives. And when more money flows into the system, investors are usually the first to benefit. Looking ahead to 2026, the direction is becoming clear. The government is preparing to inject more money into the economy. The Federal Reserve has already shifted away from tightening and is preparing to expand again. Historically, this kind of environment has favored asset owners. When new money is created, it doesn't lift everyone equally. The average worker might see a small raise, but inflation often eats that away. Meanwhile, assets like stocks, real estate, and commodities tend to rise faster. Over time, this gap quietly makes workers poorer and investors richer. That's why understanding this system matters. If you see what's happening and position yourself correctly, you can benefit from it. If you ignore it, your purchasing power slowly erodes. This video is about helping you understand which side of that equation you're on. Before going further, I want to remind you about something important. On January 13, 2026, I'm hosting a free live investor workshop. I'm doing this because the economy shifted rapidly in 2025, and 2026 is shaping up to bring even bigger changes. We're seeing artificial intelligence reshape the job market. We're seeing major shifts in government spending and monetary policy. And the Federal Reserve is once again opening the door to easier money. All of this creates new risks, but also new opportunities for investors. During this live workshop, I'll break down how these changes are affecting the economy. More importantly, I'll explain how they can create investment opportunities in 2026. The session is free, but registration is required. The workshop will run twice on January 13th, once at 10:30 a.m. Eastern, and again at 8:00 p.m. Eastern. Space is limited, and past workshops have filled up quickly. If you're interested, the registration link is in the description below. Now, let's look at where we stand at the end of 2025. The stock market is up roughly 18% for the year. Gold prices are up around 67%, and silver has climbed more than 70%. Those numbers tell a very important story. When stocks rise, it's usually because investors believe companies will create more value in the future. Higher profits, new products, or stronger growth prospects push share prices higher. That's why people buy companies like Amazon, Nvidia, or McDonald's. Gold works differently. People don't buy gold because they expect it to suddenly produce more value. They buy it because they're worried about the purchasing power of the dollar. Gold and silver act as protection when confidence in currency starts to weaken. Over the last century, gold has only outperformed stocks during specific periods of economic stress. We saw it during the Great Depression, the inflation crisis of the 1970s, the dot-com collapse, the 2008 financial crisis, and the pandemic. Seeing it happen again in 2025 should get your attention. The reason behind this move is simple. Money creation is accelerating, not slowing down. Government spending continues to rise, and deficits are growing. The budget plans for 2026 involve trillions of dollars in spending that isn't fully funded. At the same time, the Federal Reserve has ended quantitative tightening. That signals a return to easier monetary conditions. More money entering the system usually leads to higher asset prices. This pattern has repeated over and over throughout history. For the average worker, the math doesn't work the same way. A 3% raise sounds good until inflation is also running at 3%. In that case, you're standing still. If inflation runs higher than your raise, you're moving backward even though your paycheck is bigger. As prices rise, everyday purchases cost more. Food, housing, and services slowly become more expensive. Only a small portion of those higher prices goes to workers. Most of it flows to business owners and investors. This is why so many people feel frustrated. We're rarely taught how money actually works. We're taught to work harder, not to own assets. But the system itself rewards ownership far more than labor. Public companies operate under a legal obligation to serve shareholders. Executives are judged by how well they increase stock prices. If they fail to deliver returns, they are replaced. This keeps the entire system focused on investors. The tax system reinforces this structure. Employees face the highest tax rates and the fewest deductions. Investors often pay lower rates and receive more favorable treatment. Over time, that difference compounds dramatically. Many people assume stimulus helps regular households the most. In reality, stimulus is designed to boost economic activity. When people spend that money, businesses earn more, and investors benefit. Spending flows upward. This is why simply earning a paycheck isn't enough to build wealth. Income helps you survive, but assets help you grow. Ownership changes the outcome completely. That's the difference most people are never taught. Looking ahead to 2026, interest rates are expected to move lower. Changes at the Federal Reserve and political pressure could accelerate that shift. Lower rates make borrowing cheaper across the economy. Cheaper borrowing increases demand for homes, cars, and other assets. Homeowners may refinance and pull out equity. That extra cash fuels more spending, and more spending pushes prices even higher. Relying only on wages in this environment is risky. Historically, wages rarely keep up with inflation over long periods. This trend has been studied for decades, and it's expected to continue. In fact, it may accelerate in 2026. Policymakers have made their intentions clear. They want markets higher. They want growth to continue. While nothing is guaranteed, their actions show what they are working toward. Even if markets fall temporarily, history shows governments respond with more stimulus. Crashes often lead to aggressive intervention. For long-term investors, those moments can create opportunity. None of this is financial advice. Investing always involves risk, and losses are part of the process. Everyone should do their own research and make their own decisions. Never blindly follow anyone online, but understanding how money flows gives you an advantage. Lower rates, increased spending, and monetary expansion tend to lift assets over time. We're seeing all of these forces align heading into 2026. This is exactly why I'm hosting the live workshop on January 13th. These changes are happening quickly, and preparation matters. Being early is very different from chasing trends later. More money is coming into the system. Asset prices tend to rise when that happens. If you rely only on savings and income, inflation works against you. Ownership helps protect your purchasing power. Investing is a long-term game. Short-term moves don't matter as much as staying positioned over decades. History has shown that patient investors are rewarded. The key is understanding the system instead of fighting it. Money is changing, policy is shifting, and 2026 is approaching fast. As an investor, the general rule is simple. Don't fight liquidity. Learn how to move with it. And with that, I'll see you in the next video on YouTube.